Okay. So we'll continue from where we stop, right? This is your over absorption, right? Then the next thing after this, after you add everything, you have, don't forget, you have your total income, right? You can have your total income here, put your XX, right? Your total income. Is that not so? This will be your total income, right? Then if that is established, right? Your now the next thing is your expenses, right? Don't forget your expenses. In your expenses now, in your expenses, you now bring in your variable selling. Do what? You bring in the variable selling overhead. Why? It is variable selling. It varies with sales, not production. Don't forget I said you can only charge your full cost to production, not your sales, right? Your variable selling, what you will do is that your variable selling production overhead cost will still remain your VSPO, which is variable selling production overhead, right? Variable selling production overhead times the sales unit, right? The variable production overhead, the variable selling production overhead, right? The variable selling production overhead per unit times the what? The sales unit, right? It still remain the same. Please don't go and charge it as full cost, so because did you use it to produce? You don't use it to produce. You only use it. You only use it when you want to make sales class. Your variable selling production overhead will still remain the same. Oh. Multiply the unit cost, the unit times the sales in units, right? Please don't go and charge full cost oh, because your variable selling is for sales, not for production class. Now, if that is established, if you have your variable selling, variable selling will be your expenses because you did not use it in a production, and that is why it is an expenses, right? And that is why it is what? It is an expenses, right? Now, after your variable selling, you could have another expenses, maybe maybe selling, fixed selling, you can have fixed selling overhead, right? You put it here if you have fixed selling overhead, right? Your fixed selling overhead, right? So coming the okay. Okay, fixed selling overhead, right? Now, please, class, you can have fixed selling overhead and distribution. Class, please don't bring in fixed production overhead again. Oh, please don't bring in fixed production overhead. Why? Because you have already used fixed production overhead to calculate your over and under absorption. Because don't forget what you use. You use fixed production overhead. Your OAR, you use budgeted fixed production overhead. Please don't bring in fixed production overhead. You can bring in these expenses, which is fixed selling is an expenses. Variable selling production is an expense. You can have fixed distribution is an expensive, but don't bring in fixed production again. That is that means you are treating it twice because you already treated it as over and under absorption. You've used it. You don't need to bring it in your expenses. Now, if that is established, now, what you will now have when you deduct, what you will have is okay. Let me add under absorption, right? Under absorption, right? So we can have that here as under absorption, right? And that has been established in work 3. So if this is the under absorption, right? So what we have, you deduct it from your total income, your income, the money you made, right? When you deduct it from that income, what do you have? You have your profit, right? Right? You have your what? Profit. You can get your profit or loss, right? And you can see that there is no contribution here. You can have profit Is it possible to have profit or loss, right? So it depends. If your expenses, what you incur is greater than your income, you could have what? You could have loss, right? And this is all about the format of marginal absorption costing. You can see that the format is very simple as ABC, right? It's very simple as ABC. Don't forget that your closing cost here, your closing inventory here will be an opening inventory in year two. The same thing still applicable. The cost that you have here in year one will be taken forward, will be taken forward to year two as your cost here. So which means that the closing inventory of year one will be opening inventory of what? Of year two. And that is all about the format of marginal cost, of absorption costing. Class, unmute your mic and ask your question before we continue. Hello.
Hi, sir.
Okay. Do you have question? So can we move on now?
Yes, sir.
Okay. Okay. Now, if this is the format of the absorption costing, right? If this is the format of the absorption costing. Now, don't forget that we have one question on that we're actually doing on the marginal and absorption costing. So you can see things to note when solving illustration on marginal absorption costing. You need to note your under absorption costing. Under the absorption costing, always ensure your statement shows gross profit and net profit, right? Right. So, and under marginal costing, always ensure your statement shows contribution as well, right? Then you can see the differences, class. The differences between marginal costing and absorption costing is the difference is it arises as a result of the valuation of inventory, right? That is why you should not have difference in the profit, but because of different valuation of inventory, absorption costing use full cost, marginal costing use variable cost because of the differences in valuation. So that is why they will always have difference in what? Difference in what? In their profits, right? And we will still look at reconciliation statement, class. Now, in this reconciliation statement means that when you, for instance, you may not see a question that will come directly prepare marginal, but but this marginal and absorption costing, you will use it from the beginning of we will use it from the beginning of performance management till the end of performance management. That is why it is very important. Now, I remember that we've solved the marginal costing of this question. Is that not so, class? We've solved the marginal costing of this question. Then we are here to do justice to the absorption costing. Please give me some minutes. Okay, now with that format now, can you solve absorption costing now? Can you do it, class? Should we use that as your assignment? You should solve the absorption costing of next gen professional associate. This question. Hello, should it be your assignment?
Yes, sir.
Okay. I believe that the format is well explanatory, so I believe you can do it. So your assignment now, this is it. To see it is not all about saying by God's grace I will pass. By God's grace, grace does not work in isolation, right? Grace does not do what? Does not work in isolation. You have to work for it, right? You have to work for it so that you can be able to achieve the stated objective. Now, your assignment, use the format of absorption costing. Use the format of absorption costing, right? I will show you the format again. Use the format of absorption costing. Listen, watch that video again, then solve this question, send it to the platform. We will look at it together, right? You must do it. Please, if you did not do that assignment, I will not allow you to join the next class again. Please, you must attempt it. Attempt it. So that in our next class, we will just go to reconciliation. We will just do the reconciliation statement of marginal and absorption costing. Then we move on from there. Class, do we agree with that? Are we good with that?
Yes, sir.
Okay. Okay. Ibrahim,
Yeah, thank you, my comrade. Are you hearing me?
I can hear you.
Okay, please, how do we get the format? Because I'm just joining right now.
No, no, you are just joining. So you go and watch you go and watch it on the YouTube. It's there. So as you are watching it, you put it down. You can actually put it down on the YouTube as you are watching it, or you can equally download itself, so it will make work easy for you.
Okay,
Do
so
you get?
which video is that? You number the videos,
Yes,
the one you normally posted. So
yes.
which number is it?
No, I will just put absorption costing format. So you go there and watch. I will put it. You see it.
Okay,
I will equally show you
thank you,
before
sir.
the end of this class as well. So that if you want to screenshot, you can screenshot it. Leslie Bombs.
Okay, thank you, sir.
Sir,
That's
good evening, sir.
Yeah, good evening.
Good evening, sir.
Good evening, I can
Sir,
hear you,
I
please.
was thinking that I was saying if we could solve this one for this first one as after the format was given, then subsequently we'll solve the other one. That's what I was
You can,
thinking.
my Leslie Bombs, you can actually do this thing. You can do it. There is nothing there. It is still the same
Okay,
thing. I believe you can do it. See.
okay, sir. We'll
Okay.
try.
This is okay. No, it's fine, it's fine. And this is 554. Okay. 554. 554. I'm coming. We've done the marginal costing of this question, right? We've done the marginal costing of this question. So you just be giving me figure. You just give me figure. Let me just copy this format. Okay. Just give me figure, please. Uh, then anywhere we finish, you can continue from there. Okay. Suggested solution, right? So what is the name of this company? Next Gen Professional Associates. Right? The question says prepare profit statement using absorption and marginal costing technique for the 2 months. So we'll change it to 2 months, which is January as well as February, right? So anywhere we stop, you can continue from there, please. So uh determination determination of profit statements. Please, all these headings are very important, please. It's very important in PM. Your presentation, determination of profit statement using absorption costing. So you don't need to write full costs. You don't need to write full costs, right? Now, If that is established, please quickly go to the marginal costing. If you have the figure, give me the figure for sales. It is still the same thing. Give me the figure for sales. Give me the figure for year 1 and year 2. Do you have it? Class. Hello? Hello, are we still together?
Yes, sir. Yes, sir.
Yes, sir. Yes, sir.
Yes, I think you should give me figure for year 1 and year 2. The sales, we've done the sales already before now. The selling price of 45 times the unit produced of times the sales unit. So you don't have it in your notes. Away. Oh, okay, I get. So with that, since you don't have it in your notes, please go and
You
solve
have
it.
it now.
No, you don't have it. If you have it, I say give me figure. You did not give me
Ah,
figure.
sorry. Okay, sorry for January. That one is 315,000.
Three.
315,000.
Okay.
So for February,
For February,
393 750.
393 750.
750.
393 750. So, class,
Yes,
are we
sir.
good? Are we good to go? Now, if this is established
Yes.
as okay, thank you. If this is established as the sales, don't forget that it's still the same sales that we did in what is it called, marginal costing. Now, the opening inventory, we have already determined the opening, right? We have already determined the opening and the closing inventory. Now, the only differences here is the valuation. Don't forget that when you want to get the value of opening inventory, right? You use full cost. You do what? You use full cost. You multiply it by the inventory. Now, we have already determined the opening and closing inventory. You can see it under the what is it called? Under the marginal costing, right? We've determined that using what? Using marginal costing, right? You can see the opening and closing, no opening inventory in January because it was stated in the question. So that means that in January, there is no opening inventory. There is no what? There is no opening inventory. You can put your dash. Now, your production cost now, use full cost per unit. You will now multiply by the what? By the unit produced, class. Full cost per unit. Now, what are the full costs given to us in the question? Let's start from the variable cost. You can see that the variable costs, I don't need to, we've done it before. The variable costs are the direct material cost. You can see it. Direct labor cost is a variable cost. Is that not so? Variable production overhead is a variable cost. We are adding all these variables together. Is that not so? Now, fixed production overhead cost per unit. They've given us the fixed production overhead cost per unit. Variable selling. This is variable selling overhead, and this is what? This is fixed selling overhead, right? This is fixed selling overhead, and this is what? This is fixed administrative overhead. Is that not so? No, now we need to bring out the variable cost first. When we bring out the variable cost, we now add the OAR, which is the fixed cost. We now do the fixed cost per unit, right? Now, in this question now, you can see that we're given different fixed costs. Is that not so? The first one is for selling. You can see that we have the one of production of 3 naira. Then we have the one of fixed selling, and we have the one of administrative, class. The fixed selling overhead is your expenses. The fixed administrative is also an expense, but the fixed production is the one that is attributable to the production. That is your OAR. You can see in this question, your fixed production overhead cost is given already. So you don't need to do budgeted overhead over budgeted levels of activities. Why? Because the unit cost, you can see it here, the unit cost of fixed production overhead is given already. Now, your fixed selling overhead is a fixed selling overhead is sales, is an expenses, sales, selling. It is attributable to sales. It does not attributable to production. So you will not add it when you are doing your full cost. Your fixed administrative overhead is an expenses, is a fixed cost. It does not attributable to production. The only fixed that is attributable to production is the fixed production overhead cost per unit, which is given, which is your OAR, is given already. Right? Now, in this case, we'll go to our step. Right? Step one. Step one. Right? So let me quickly copy the determination. Let me quickly copy the determination of unit costs. Okay, this is it. Let me quickly copy this. Okay, step one. Class, are we still together? Okay.
Yes.
Okay.
Yes, sir.
Did you get the explanation? Please, did you get the explanation on that? So now we have the direct material cost. So what is the unit cost of the direct material, class? What is the unit cost of the direct material?
11.
11 naira.
11 naira.
So what of direct labor?
8 naira.
8 naira. Please check your question again, please. Okay, variable production overhead.
4 naira.
4 naira.
Okay, 4 naira. Now, the next overhead that we have, please, some student will go and add, I know, some student will go and add fixed selling overhead as part of full cost. Because it is fixed now. No, now, fixed selling is for sales. It is not for production. Fixed administrative, it is not for production. It is an expenses, class. It is an expenses. The only fixed that you attributable to production is the fixed production overhead cost. And it is given in the question, which is your OAR. You don't need to do budgeted overhead over budgeted levels of activities, class. Now, if this 3 naira is not given, you can see in the next paragraph when you have fixed overhead cost is incurred on a normal annual activity. You can see they absorb their overhead on the basis of unit produced. Their fixed overhead cost is based on the unit produced. It's based on this unit of 96. It's based on what? This 96, right? It is based on what? This 96 units. But we don't need to do budgeted overhead over budgeted level because it is given as 3 naira already. So we quickly go back and put your words. When you want to value, then you quickly put what? 3 naira, right? So when you add it, what do you have? When you add it, what do you have?
26.
Okay, 26. So we have fixed. We can put fixed production. Let me put it that way. You can see it's given to you in the question, right? So let's just remove the fixed production. The explanation is clear, right? It's clear. Now, if that is established, addition of this, what do you have? Sorry, addition, what do you have? Addition of this, what do you have?
26 naira.
26 naira. So now the full cost that you will use to value your inventory is 26 naira. Class, the full cost that you will use to value your inventory is what? Is 26 naira. So now you can now go to that you use to value your inventory as well as your production, right? So you remove this cost. Let's remove this cost, or you can leave it anyhow. Now your full cost is 26 naira. You can do these workings in your workings outside this times the unit produced. What is the unit produced in year one? what is the unit produced in year one? In January, sorry. In January,
Eight,
that is
eight five.
8,500, right?
8.
85. Okay. 8,500. Okay. If that is established, we can have 8,500 units, right? 8,500 units, right? So what do we have? Give me figure, please. So we'll do the same thing for
221,000.
okay,
221,000.
221,000. Thank you for that. So 221,000. So you do the same thing for February, right? It's still the same. We assume that they have the same full cost, but sometimes you may be given different direct material for January, you give for February, you give they will give you different labor for January, give you different for February. You can now, oh, they have different direct material, but the fixed cost per unit will be the same, which is your OAR that you calculated. You put it same in January as well as what in February, then you add it to move on as your full cost. Now, if that is established, this one will still be 26 times what is the unit produced in February? 7,750, right? Right?
Yes, yes.
7,750. Okay, good. So 7,750 units, right? 7,750. Okay. What figure, please? Figure.
201,500.
201,500.
Okay, 201,500, right? So if that is established, right? We've done that. If that is established, don't forget that we still have the opening of February, right? So the closing of January will be opening of February, automatic, right? When we get there, now we are there now. Now, you still do the same thing here. Use total variable cost per unit plus the fixed cost per unit to multiply the inventory, which is the closing inventory. We already calculated, we already determined we've done determination of opening and closing inventory. So you just give me the closing inventory you just give me the closing inventory, please, for January. Just give me the closing inventory unit. What is the closing inventory unit, class? Based on the marginal costing that we did, class. What is the closing inventory? We've done it before,
23
right?
naira per line.
23.
Is what?
1,500.
23 naira per unit.
Wahala. Closing inventory, the unit.
34,000.
That's 26.
34,000.
Okay,
Hey,
34.
my people. Hey. Okay, where is it? Where is it? Determination. See, look at it here now. Is it not 1,500 units? Determination of opening and closing inventory. Inventory, the stock. Is that not so? We've done it before. This
Okay.
8,500 units, this is sales. This is your unit. Unit. I say unit. I didn't say it's 1,500 units now. Is that not so? Right? And that is it. It is what? 1,500 units. 1,500 units. Right? So you can multiply. What do you have? Multiply. What do you have? Figure. Multiply. What do you have?
26,000.
What do you have? 26.
39,000.
29.
29,000.
39.
Okay, 39.
39,000. 39.
39,000. Okay, 39,000. So the closing inventory of this will be automatic, becomes the opening inventory of this. The cost, the same cost of February. Please, the same cost, even though if it is year 1 and year 2, the closing of January will be opening of February, right? So you can have 39,000 as your opening, right? You don't need to multiply, no. The closing of inventory of January will be opening of February, right? Now, if that is established, class, quickly, what is your closing inventory what will be your closing inventory? Class, what is your closing inventory for February? Closing inventory
500
for
units.
February is what? What is the unit? Class,
500 units. So
500. 500.
13,000.
thank you, thank you.
100 units.
500 units. Please, if this is magic, go and watch the marginal costing, because everything you need to know, unless you did not go back to what we did last time, that is it. And I can tell you that if you go back to it, you will understand. Now, if that is established, what is the figure? When you multiply it, what do you have?
13.
13,000.
13,000. Okay. 13,000, right? So 13,000. So now you minus, right? We quickly minus 221 minus 39,000. What do we have? So that we can determine our over and under absorption that we
182.
when
182.
you 182
One,
182, right? 182, right? So next, what do you have next?
188. 188.5.
Okay, I'm coming. 188,500. Please, others should confirm that. Please confirm.
No,
Hello, please
no,
confirm.
it is 227,500.
Okay, now let's do it together.
227,500.
Let
500.
let's do it together. 39,000 plus for February, 39,000 plus production cost 201,500 minus 13,000. What do you have?
227,500.
227,500. Sorry. I
227.
didn't add that thing.
Okay. Next, what is the gross profit? Remove it from your sales. What is the gross profit? Quickly for January or for February? Quickly.
For January, 133,000.
Okay, January is
130.
133,000, right? 133,000. Now for February,
For February, 166,250.
160 is 250.
166, 250. You can
250.
see that there is difference
250.
in their inventory. You can see there is difference in their inventory. The marginal costing have different inventory, opening inventory cost. Absorption costing have different opening and closing inventory cost. So these are the different. This is what make absorption costing and marginal costing not to agree with each other, right? Now, when you are doing something like this in exam, you can confirm if your answer is correct or not. That is why there is reconciliation. We already know reconciliation in financial accounting. If you start with profit as per marginal costing, you end it with profit as per absorption costing. We will get there, right? Now, if this is established, class, the next step is oh, the next step is under and over absorption, right? The next step is what? Under and over absorption, which is what? Step 3. Now, with that one, this will not take much of our time because we have established that earlier. So now, let's quickly go to step what? It will be step 3, right? Or, okay, we'll use step 2 here. Okay, let it be step 2 here. Okay. Right, class? Are we still together? Step 2. Let me copy. Okay. So let me quickly copy the format. Over and under absorption. Okay. Let me copy determination. Determination. You can do it together though. So let me copy this down quickly. So after that, you can do the profit statement, right? So we will now have for January and what? For February, right? January and step 2. So let me clean this. January and February. Okay, you're coming. February and January. Okay. So we quickly move to over and under absorption. Right. Now, class, what is the actual fixed production overhead? Now, in this question now, let's quickly go back to the question. In this question, we were given that what is the actual fixed production overhead? The actual fixed production overhead, it is not even stated, right? But don't worry about that, right? Let's calculate our, what is it called? What is it called? The OAR. We've already calculated the OAR. They've given us in the question already, right? Which is the fixed cost per unit, or the OAR, which is the 3 naira. It is given directly from the question, right? So we can say for January, which is 3 naira, which is the production. Don't forget, it is fixed production overhead cost per unit, which is 3 naira, times the actual unit produced, times the actual unit produced for January. So what is the actual unit produced in January? Plus, what is the actual unit produced in January? What is the actual unit produced? Production is 8,500 units, right? Class, 8,500 units, right? Okay. Are we tired? 8,500. I guess we are tired, right? And that is it. So multiply this. What do you have? What is your overhead absorbed first? Let's get the overhead absorbed. What is the overhead absorbed?
20 to 25,
Okay,
25,500.
25,500. Okay, Temidayo. Temidayo, unmute your mic.
I hear you, sir.
Yeah, your hand is up. Any question? Do you have question? You raise your hands now. Okay.
That was a mistake. Sorry.
Okay, that's fine, that's fine. So when you multiply, what do you have? When you multiply, what do you have?
25,500.
25,500.
25,500.
Okay, 35. Okay, 35,500.
25.
Now,
25.
500. Okay. Now, class, let's quickly go back. Now, in this question in this question, the actual fixed production, the actual fixed production, the actual fixed production is not actually given. That, oh, this is the actual cost, oh, that they eventually incurred in the what? In this process. Class, what do we do? Do you have an idea of what we can do to this question? Class, how do we determine our actual fixed overhead cost now, since it is not given in the question? Hello,
I
are we still together?
yes sir, yes sir.
Okay. So what do we do? Everybody is muted. Hey, okay. Now,
Let me try.
okay, try. Thank you.
Please,
Try.
don't judge me by my answer.
Okay, no.
I what I feel is that the normal activity level divided by 12, whatever we get multiplied by 3. I don't know. Is it correct?
Oh, okay. The normal activity level, which is the 96,000 units. Is that what you say?
Yes.
No. Uh, okay. You try. Well done. So in this case now, the actual fixed production unit, the actual production is not given, but we can change it. Now let's use another technique now. So now, since the actual production is not given, right? Let's change it to let's have something different, right? Let's have something different. January, February. Sincerely, I didn't even check this question before this class. I didn't even check if it's marginal cost, absorbent cost, no. So now let's change the techniques now. Sure. What is the actual production? What is the actual production? Actual production units for January is 8,500 units. Please, what is the actual production for February? I think it's 7,000 something. 7,000 what? Is it 750 units?
750.
Okay, 750 units. Now, what is the budgeted? What is the budgeted? Budgeted, budgeted, budgeted units. Oh. What is the budgeted unit? Class, what is the budgeted unit? Let's go back. Who can give us what is the budgeted unit from this question? Class, you can see
8,750. That's for February.
no
No,
budgeted units.
7,750.
No budgeted units. Budgeted. No, your
Okay.
budgeted is there. Your fixed overhead cost is incurred on a normal annual activity level of 96,000 units, class, and it is expected to be incurred at the constant rate throughout the year. All these things that you are seeing here, this place is your actual, right? You can see that your budgeted will be given to you based on the normal annual level annual activity. This annual means 12 months. So the annual budgeted annual level, you can see they did not even write it as budgeted, but when you see fixed that is being attached to a unit, you can see fixed that is being attached to a unit, you should know that, oh, this is your budgeted, oh, because your actual can never be attached to that, right? Your actual will be given separately in the question. Now, fixed overhead cost is incurred on a normal annual, that is their fixed, that is what is constant. That is what they budgeted for. And don't forget that this is 96 units and we are doing for January. Is that not so? We will divide it by 12 so that we will have for each of the what? For each of the months. When you divide 96,000 units divided by 12, what do you have? You have 8,000 units, right?
8,000.
Okay.
Yes.
Okay, thank you. So you have 8,000 units. So you can have 96,000 units divided by 12, right? So this gives 8,000 units. This gives 8,000 units. Now, class, what is the difference? Class, what is the difference? What is the difference? Quickly. So from this, we can pick if it is
500.
January is 500.
the first one is what? 500,
500.
right? Okay, 500. 500 units. What is the difference of this?
250.
250, right? 250. Now,
Sorry, you wrote 50 units in January.
you say,
You wrote 50 units in January instead of 500 units.
okay, the actual production unit is what? Is it 500? Actual production unit in January is
No,
8,500.
what I mean is difference. I'm talking about the difference, sir.
Okay. The difference. The difference is what? Sorry, 500.
The difference is 500, yeah, not 50.
Okay, thank you. 500 units. So from this now, we can determine if it is over and under, if it is, do we overproduce or we underproduce? Now, the budgeted units produced Okay, Precious.
Okay, sir, please, for this your overhead absorption, the amount there is supposed to be 25,500, not 35,500.
Okay. I've actually changed the okay 2025, right?
5,500.
Okay,
Yes.
25,500. Okay, that's fine. I've already changed, so I've switched to another method since the question did not give us actual production. I've switched or I've changed this thing. So now you can see that in this question now, your actual fixed production is not given to you. Precious. Okay, please put down your hands,
Yes,
please.
sir.
Okay, do you have question? Okay. Now you can see in this question, Precious. Oh, okay. Now you can see in this question now, your actual fixed production overhead is not given. Is that not so? Actual fixed production overhead is not given. Now the question is, we need to change the method because actual fixed production overhead is not given. They did not give us that the actual fixed production overhead that they incurred is 2 naira. Let's change the method and I say, oh, we're given the actual production, right? Budgeted unit. Is that not so? Now, what is the difference? You budgeted for 8,000 units and you produce what is it called? 8,500 units. Is it over or under? So I think we need to go
Over.
from here.
Under.
Okay, okay. So I think we need to go from here, right? We need to, yes, I think they've just sent a signal to me now. So I think we need to go actually. We've exceeded our time. So on Tuesday, we'll continue from this part, right? On Tuesday, we'll continue from this part. Trust me, performance management is not difficult, it's not hard, right? Please go back to the previous videos, watch it, jot down, write, right? Please